All right, Money Vikings, I got a good one for you today. I want to do a video on a little walking video here, and I talk about real estate today, and that's why I'm surrounded by real estate. But I want to talk about why I'm doing a hard pass on the concept of the 50-year mortgage. So that is like just the worst idea I could ever imagine, and I'm gonna tell you exactly why. It's a very, very bad deal for consumers. It is just it's just awful in so many ways. The bottom line up front, I would appreciate it if you would watch some of the details of the video, but I'll give you kind of the quick down and dirty. I mean, the reality of the situation is that when you're talking about a 50-year mortgage, you're going to save a very small amount of money every month, and you're going to get a whole lot of added interest payments, and you're going to pay a lot more for that real estate asset when you're talking about a 50-year versus a 30-year or a 15-year, ideally, mortgage. So you're just not going to get a lot out of it. So I'm doing a hard pass. It's a no thanks, very bad idea. Again, so it slightly lowers the monthly payments, but it does very little for you in terms of paying off the asset and having an income producing asset, and it does very little for you, etc. It will actually it also has a macro problem in that it will actually drive housing prices higher. So there's a bit of a problem with that as well. So you're gonna get higher housing prices because you'll have a lot of, you'll have people flooding to this idea, but it's just not good. I see it as a long-term wealth destroyer as well. So I definitely see it as a negative. Now, it's a positive if you're a bank, because they can extract much more interest out of you over the long run. So definitely a positive for the banks. But I think definitely a negative for the consumers. So let me go into some of the reasons why here. Let's kind of figure it out here. So mortgage rates are mainly connected to long-term bond yields, and the reason for that is basically an ROI. It's a return on investment type thing. Okay, so if you can get more money and basically it's like a long-term bond. If you can get more money and more of a return on your investment on long-term bonds, why will you be investing in mortgage-backed securities and mortgage-backed assets? Because there's just really no incentive to do so, and you can just seriously park the money in a bond, and you're going to have a lot less risk than dealing with mortgages. So I looked at some of the numbers. If you're looking at a loan example, a $400,000 loan example, what you're seeing is you're basically seeing on a 50-year mortgage versus a 30, you're getting about a $75 a month lower monthly cost. So nothing. I mean, when you're talking about a mortgage, I mean, that is like such a joke. Like, that's nothing. And the 50-year results in less equity buildup, and basically the interest that you pay is a lot higher. So you're going to be paying a lot more interest, and you're getting less equity buildup. That's the key with real estate, is that you want to get to that point, 5-10 years down the road with that property, you're sitting on a fat stack of equity, and that equity can be pulled out and leveraged and put into other assets. The asset can be sold, and then you can basically just have the equity. So that's an option as well. But equity, the reason I bring this up is that equity is a long-term Money Viking secret of wealth, right? So wealth building can definitely go onto hyperdrive when you are building equity in a real estate asset, in a piece of property. So I believe that this sort of 50-year scheme frustrates that in a lot of ways and makes it harder for the individual wealth builder to achieve their goals. The other thing I want to say is that I understand, the reasoning behind it is, I think it's trying to make housing, well, I don't even know what the reasoning is behind it. I just don't like it at all. I don't like it in many ways. If we want to solve a housing crisis or an affordability crisis, there's two basic ways in my mind to do it. So number one, we have a supply crisis. There are not enough starter homes. There's not enough single family homes. There's not enough homes in general to deal with the amount of demand for owning a home. So I would like to hear things like, you know, that whole mantra of drill, baby, drill. I'd like to hear build, baby, build. And what that would do is that would increase the supply, and over time you are going to lower the cost on average of housing for people, especially starter homes. We need more starter homes. So it'd be great if there were incentives in starter homes. And the other thing I'll mention is that we want to be in a situation where we are getting interest rates down a little more. So interest rates are the big lever in my mind. You know, instead of going 50 years, let's focus on the interest rates. If we can get the interest rates down a little bit more, that can really make that monthly payment more affordable. And it will, again, allow people to build wealth a lot faster. So, you know, those are some of the keys. So again, I'm not a fan of this 50-year mortgage thing. I believe, like in Star Wars, I think this is a trap. I think this is a trap for wealth builders. It's a trap for middle-class wealth builders, and that's what our channel is all about. Our whole point of our channel is to encourage middle-class wealth builders, and one of those tactics over the years has been, in my opinion, a 30-year mortgage or a 15-year mortgage on a primary residence. Now, we all know a primary residence, it's very hard to consider that an asset in the short run. In the short run, it is certainly not an asset. In the short run, a primary residence is totally a consumable. It's something that costs a lot of money. But I do believe firmly that in the long run, it can be a big part of middle-class millionaires' wealth building strategy. The issue is, I mean, at the end of the day, everyone needs a home. It's a fixed cost that you can depend on for 30 years. You know, it will probably go up in value if you are buying in a strategically good neighborhood, you know, relatively good area, in an area with a growing economy or an economy that's resilient and can deal with the stresses of the economy. Over time, you're going to be in a situation where you have a fixed cost and you're going to see the asset appreciate in value. You know, I'd much rather have that at the end of 30 years than nothing. I know some, you know, there's some situations where it makes a lot of sense to rent, and I'm not against renting at all. You can definitely, a person can definitely build wealth by renting, but I do believe that the 30-year mortgage, 15-year mortgage on a primary residence has been a good wealth building tool, generally speaking, for the middle class. At the end of the 30 years, 20 years, whatever, maybe they do want to shift into renting. Well, they get to sell an asset. They get to take hundreds of thousands of dollars back out of it, maybe more, depending on the market. You know, maybe at that point, it'd be close to $1 million. You take that out and you've got $500,000, $600,000, $700,000 that you did not have otherwise. And, you know, that could really power a person's retirement for quite a long time. So anyway, that's my bottom line. Thanks a lot for watching, guys. Please like and subscribe, that whole thing. And we'll see you on the next one. Take care, Money Vikings.